Well, here we go, chapter 1. We want to talk here just a little bit of an introduction. Most of this is things that we should know from previous classes or experiences. So we're going to go through this chapter fairly quickly. So, what is corporate finance? And essentially, the deal here or the objective is to try to find ways to provide skills um, so managers can make um, good, solid, economically viable decisions. So the skills that they need to identify and select strategies and projects that add value to the company. They also need to forecast the funding requirements of the company. Now, this is both a short term and a long term uh, set of requirements. Certainly, they need ongoing cash management, but they also have to plan for future expansion, purchase of new plant and equipment, purchase of new companies or common stock, even. So, there's lots of things that we need to have money for, and we need to decide the best ways to do that. So, again, corporate finance is that process of decision. It really makes the company flow and identify resources. If you think about how a business is created, essentially we have three forms, if you will, or three basic forms. So you can obviously start out with as a sole proprietor, and there's just one owner, one manager, if you will, as the sole proprietor. You also have a partnership and a corporation. So the question is, if you want to start off as a sole proprietor, right, how do you grow? How does your business expand if you're a sole proprietor? You're going to need money in order to buy things. You're going to need to buy plant and equipment. So you need funds. Can you use the profits of the company? If there are any, you certainly can. But we also have to recognize that most sole proprietors use the profits of the company as their salary or their compensation. So sometimes there's not much left over in a small proprietorship. What about banks? Can you use banks? Certainly we can, but banks won't lend huge amounts of money for expansion, right? As a sole proprietor, you probably won't be able to go to the bank and borrow $1 million in order to buy a building, right? So money is going to be a little bit scarce. So the only way you're going to find more money, especially if you have a lot of growth, is you need to find more investors. So that's when we use or move to partnerships or corporations. So if you're a sole proprietor, what are the advantages, right? Well, the primary advantages are it's very easy to start. There's very few regulations. And the tax structure is much kinder than it is for corporations. So there are no corporate income taxes. So taxes are paid through the 1040 of the owner. So there's not a separation between the two. Now, the disadvantages are very important, I think. Number one is it has a limited life. A partnership can only be alive as long as the owner is alive, because they're the only owner. Unlimited liability is a very important concept. We'll talk about that here in a second. And then finally, it's rather difficult to raise capital. We've already talked about the sources of capital that we need. But let's concentrate on this term, unlimited liability, right? So liability here refers to being sued. So what happens if you lose a lawsuit? Well, there's only one of two things that can happen if you get sued. You either win or lose. If you lose, the penalty is almost always in the form of cash. They really don't want your assets, although they'll come and take them, but they really don't want your assets. They want cash, something they can spend. So for a sole proprietor and a partnership, business assets refers to all the assets that are owned by the owner of the company, and this includes their personal assets. So if you're in a very risky business, right, and if you're very good at that business, you probably have some toys. They're going to come for your toys before they come for your business assets. And essentially the way this works is we don't recognize the difference between the business and the person. The business is not seen as being a separate entity. It is the owner, the sole proprietor of the establishment. A partnership is roughly the same as a sole proprietorship, has pretty much the same advantages and disadvantages. But we have two kinds of partnerships. There's something called a general partnership. And again, this is what they're alluding to here when they say that they're roughly the same as a sole proprietor. And the thing that we're talking about that really is important here is this limited liability piece. So a general partnership has unlimited liability, just like the sole proprietor. So again, one of the unluckiest persons to be would be the richest partner, because lawyers are going to go after deep pockets. So they're going to sue the people that have the most money first. Now, limited partnerships, there'll be a few partners, and in fact, could be all except for one actually, but there could be a few partners are designated as limited. What we refer to these folks as sometimes as silent partners. And these silent partners have limited liability. So the only losses that they can sustain from the business itself is if the business goes out of business, they can lose their investment, whatever they put into the money. We cannot ask them to give more money to cover bills, etc. So we have a few people who are limited partners, silent partners, and then whoever the remaining partners are, they will be our general partners, and again, subjected to the unlimited liability piece. Of course, a corporation is a legal entity. It's separate from its owners and managers. They obviously file a charter and bylaws with the state in which they are organized. Now, most corporations are actually incorporated in Delaware, and this is due to the judicial system that has a separate business section to the judicial system there. So I'm going to kind of think about it. If you're going to sue somebody here in Cincinnati and you go to court, right? The judge that's overseeing your lawsuit against this customer or supplier or whatever, maybe yesterday they were working on a divorce case, and the week before that they were on a robbery case, right? So they really don't have any expertise in the business area, and that's one of the things, obviously, we would hope that it's easier to communicate when they have some kind of experience there. So the advantages and disadvantages of a corporation, the number one advantage is unlimited life. It's very easy to transfer ownership. All you have to do is sell your stock or buy your stock. We talked about now limited liability. The most you can lose is your investment in the company. You can't lose any more. And of course, it's very easy to raise capital if you're in a corporation. The primary disadvantages are all about costs. Primarily, we're worried about it costs money to set it up. There's lots of reports that we have to complete. The bigger we are, most likely, the more we'll have to file papers with regulators, etc. But double taxation is a concept that essentially it says that as an owner, if you're a sole proprietor, let's kind of take a step back, a sole proprietor, and you pay taxes based on what you made in the company. But for a corporation, since it is a separate entity, the corporation pays taxes itself. Now, when the company then pays you money as an owner, if they distribute dividends, then you then pay taxes on dividends. So essentially, you're paying taxes twice. So how do you become a corporation? If you're not a corporation already that is trading securities, then you have to get to the public. So there's an initial public offering of stock. This can be to raise cash in general, but frequently this is a way for the founders of the corporation and some early investors to harvest some of their wealth. They want to get paid for taking all the risks that they've taken up to this point. And of course, after you are publicly trading, any subsequent issues will also then obviously be issued to the public through a system. And we'll talk about that in some later videos. There is an agency problem. So what does this mean? Well, managers may not act in their own interest, or may act in their own interest and not on behalf of their owners or the stockholders. So the greater the distance between management and owners, the more agency can be an issue. And in a corporation, it is the ultimate distinction or separation, if you will, right? I mean, Disney has upwards of 1 billion or so shares of stock. The owners of that stock, in fact, the corporation, other than seeing their name in a book somewhere, so they know how to send them dividends, etc., they really don't even know who the owners are. So corporate governance then is a set of rules that help us control behavior. So it sets up the guidance of what managers can do, what the strategy is, etc. But corporate guidance helps us control these agency problems. So if you think about the company itself, what should they be trying to do? I mean, if you think about a company like Coors, right? Molson Coors is in the business of making beer, right? So that is an objective, right? That's their business, not really their objective. Their business is making beer. But in the end, they are working for the owners, and the owners want to see their investment grow. They want to see what we refer here to as wealth maximization. We want to see the stock price go up. So should firms behave ethically? Of course they should. There should be a connection between the value of the company and the ethical businesses that they run. So, what kind of responsibilities do they have, right? So again, all of these things, ethics, your social responsibility, all of these things are part of the objectives of the company. But the primary objective, again, is to increase the wealth of the owners of the company. So, is maximizing stock price good for, again, society? And of course, we would hope that it is, right? So, what this sort of implies is that companies that are doing well, right, typically will have better employment growth. They'll have more opportunities. They'll be able to gather funds more easily as the value and as the benefits are seen by this company. So, on average, what they're trying to say here is that companies that do good things will typically see that come back in employment growth, sales growth, and stock price growth. So again, looking at maximizing stock price, right? Consumer welfare, and I don't know that I necessarily agree with this sentence, this statement. They say consumer welfare is higher in capitalist free market economies than in communist or socialist economies. And I'm not really an economist and a foreign international business kind of person. But consumer welfare is obviously an issue, especially in our country we deal with. And it's a huge expense for our company. Likewise, if you think about some of the Scandinavian countries, Sweden, Denmark, those countries tend to have very great benefits that they provide to their citizens. The challenge, though, is somebody has to pay for this stuff. So the taxation in those companies is what replaces sometimes or is what provides the funding for all those socialist benefits. Fortune magazine, if you Google this, it talks about companies that are the most admired firms, right? So you can look at and you can sort companies by a variety of variables. So again, there's high quality from customers' views, right? Customers see things, they understand, they see high quality, they accept that. And we also understand that when companies do well, typically employees like to work there because things are working better. Everybody is gaining when the company is doing well. So I look forward to seeing you in the next video.